Welcome. I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Steve Wolf, where we're here to provide you insights on the markets, planning, and taxes, and much more. And here we are. Today is January 22nd, 2026. Can't believe we're already 3 weeks into the year. It seems like this year is already flying by, but it's been quite the week. We saw the Sal America trade on Monday. Then we've seen the markets come back over the last few days. So pretty much, if you look from last week to this week, we're actually, the Dow Jones is slightly up from last week. The S&P 500 is about the same. The Russell 2000 is actually up this week from last week. So you would have thought the market, after seeing the market volatility this week, that things would be a little different. But once again, that's why we don't time the market, and we do have long-term perspectives and plans. From the interest rate perspective, looking at mortgage rates, as of today, January 22nd, 30 years at 6.13 and the 15 is 15.57. But if you'd have looked at this a couple days ago, it would have been a completely different story. So that's changed over the last few days.
It's gone up.
It did go up a little bit, but it looks like it's kind of back to where it was last week. The Fed meeting for next week, it looks like there's pretty much going to be no change unless something pretty dramatic changes over the next 7 days. But as of now, the probability of that is pretty low. So we're looking at a 95% no change. And then looking at kind of where we're at with some of the short-term fixed income, the one-year CD is actually up slightly. It's up 3.75, and the treasuries are pretty much the same at about 3.55. So not too much change on the short-term.
You give every week we give where the indices are, the Dow and the S&P and all that. And quite honestly, we don't really want to look at it every week. This is just more of a point of information.
Correct.
You know, that we think long-term investing makes a whole lot more sense than worrying about week-to-week, day-to-day moves.
Absolutely. I mean, we have met with some clients, over the beginning of this year, and we have those conversations. There's some clients that are nervous about the markets, and once again, we reiterate that we have a long-term perspective, we have a financial plan, we have an investment strategy in place, and sometimes just a reminder that we're not going to be timing the markets. And yes, we give updates. But anything can change at any moment, and obviously the news and the headlines are apparent, but we don't invest based on that.
It was good. The volatility was good for things like structured notes. Saying if anybody wants to understand that, they can give us a holler. But because of the volatility, you got higher yields on the structured notes, and so volatility sometimes can be good. You could also, Vince, you probably know this better than I do. Can't you invest in volatility in the market?
You can, and a lot of people do. I mean,
And how do you do that?
Hedge funds do it in a variety of ways. They do it mostly through option strategies, where they're going to buy either calls or puts, or they're going to try to do a butterfly spread where they buy the put and offset it with a call. So, I mean, there's a lot of ways that hedge funds do it. But most investors that are in the market, the way they control volatility is by owning really good companies. And when you do see significant declines in the market, to go in and buy those companies and then know that they are going to be there for the long term. Like you said, it's long-term investing. I, however, do like to look at the indices on a weekly basis or a daily basis.
Why?
Why? Because I think it's real important that, my portfolio it looks to outperform the indices over a 6-month, 1 year, 18-month period.
Right, but businesses don't grow in a day and they don't grow in a week.
No, I know
they grow
that.
in years.
I know that, but what I'm saying is people invest in the market for performance, and so I want to make sure that I'm attempting to give them the best possible performance and beat the indices.
So if an index is up by a certain percent in one day, how does that affect what you do as a portfolio manager?
No, it's just a benchmark that I look at and say, oh, wow, it's up. And typically, if the indices are up, my portfolio is tracking fairly closely, if not up or down by.
Okay, but for the average investor
most
out there,
guys aren't.
They don't care what happens in a day or whatever.
They don't give a rip. No,
when I look at our own business and look where we were 14 years ago when we started, or 15 years ago when we started, and what it's hopefully worth today, it didn't grow in a day, and quite honestly, there were years where it went down. So you have and it's grown nicely. Thank you to all of our clients and and all the referrals that we've gotten and everything else. So it takes time to build a business. So I think that looking at as the average investor, not as someone who might trade, looking at the indices on a daily, weekly, even monthly basis is futile.
Well, it's interesting. Rachel and I had a conversation on our Savvy series this morning, and while we think investment performance is important, when we deal with some of our clients, we also look at it from the core values, financial planning, goals, and kind of more intentional. So once again, well, the performance is important, but that kind of ties in, once again, what's the purpose of the money and why? And so looking at, we actually just had this morning, Rachel and I were at a Carlsbad Chamber of Commerce NetForce meeting this morning, and we heard from Dr. Yvonne Scarlett, who had a conversation on the art of living well. And so one of the things that she talked about was Yang Shen, which is kind of it's called Yang Shen.
It's a relative of feng shui.
And so
it's the art of living well.
Yes. And so I thought I'd share, because obviously we want everybody to live well and live healthy and have long life expectancies. So one of the things that got brought up was for the month, a couple ideas to think about to live well is perhaps go on a lunch date with a friend, 24 hours with no social media.
Or phone.
Yes.
24 hours without
No
social
phone.
media.
Can you imagine?
Our phone. I didn't have my phone this morning for a few hours, and I have to admit I felt a little off.
A little rattled?
I did. I was like, I didn't have my phone with
where
me.
is it?
I know. Another idea is a full day of outdoors, so just kind of spending a whole day outdoors. Another one is a night out with friends, a date night either with someone or even yourself. So just kind of taking a day or an evening with yourself.
Go solo pilot.
There you go. Why not? A movie night, a day of serving others, and one day completely to yourself, whether it be meditation, walking, whatever that is. So I just thought it was. I know we always talk about money and finance, and just for us, for me, it really hit home in that taking a step back and reflecting on making sure you're taking care of
But
your well-being.
it's important though to have some money, because when you want to go out on that date,
You need to have
want to
money.
be able to pay for it.
That is true.
You could go on a walk
You need
on the
investment
beach.
performance.
What'd you
You
say?
need your money growing for you.
That's right.
I said there are things you can go and do as a date that don't cost money, like going to the beach and going for a walk, or just walking around your neighborhood.
Oh, you're so positive, Rachel.
Wow,
I love
there
it.
you
Yes.
go. Yeah, she's ready.
No, I gave
love
up
it.
complaining this month.
There you go. Nice.
Well, I'm going to jump in real quickly before everybody gets into some other stuff. But I did, and I'm not sure if I have these numbers correctly, but I thought I saw the GDP for December was up 4.4%. I know you have those numbers a lot.
I do. I don't have it with me
Okay.
at this moment.
But then I heard also today that we may see at the end of January a 5% plus GDP number, which is terrific. I mean, the economy is.
So what does that tell you about interest rates? It doesn't seem to me that interest rates are going to go down.
Again, I mean, probably when you look at it from, kind of a, I don't know. When you look at it from a standpoint, should interest rates come down? No. But when you look at it from a political situation,
Well, but
that's different.
That's my whole point.
So again, I'm not sure, but I think more importantly, the market right now and investors, they're looking forward, and that's why we're seeing a lot of volatility right now. They're trying to understand the aspects of this one big, beautiful bill that's coming up. And I think, they're trying to digest what's going to happen with corporate tax cuts, individual tax refunds, business deregulation.
I think a lot of what Trump's policies are Reagan's policies on steroids. But then he comes out and he says that, he wants a Fed chair that wants to lower rates. And I don't think those two things are compatible. It's good. I mean, what's going on? I liked Reagan's policies. I actually like Trump's policies as far as, the economy is concerned. It's good that we're growing, but you can't have that kind of growth and then lower interest rates, or you're going to have inflation that's out of hand.
Well, I think that they're attempting to do whatever they can to keep inflation under control, because obviously there's that big affordability problem that's out there. But again, the market is, it's not seeing a lot of clarity on some of these issues. So they're trying to figure out, okay, how is all this going to affect the economy going forward? And when there's uncertainty, markets are very volatile. So I think, we're early in the year. markets and investors are again attempting to address big tech profitability. The monetization of AI investments, how much, how quickly, how is that going to come about? And next week, was next week the 26th? Yeah, starting the week of the 26th, you'll start seeing big tech reporting their Q4 revenue and interest revenue and earnings reports. Most likely, these companies are going to start addressing, I think, the profitability of some of their AI investments. If they do, I think they're going to say the same thing I've been saying for a while, as they're going to push things out and say, the second half of 2026 and on into 2027, we are going to start seeing significant profitability on these investments. So, again, I'm looking forward to hear what these companies have to say on their conference calls. And, as a result of that, I think the markets can, it can be a very positive or a very negative move in the market. But I think if the companies address it properly, I think the market will take it favorably.
It's interesting. There was a company that came out today with earnings, and I won't mention the name, but it came out with earnings, I think it was last night, and the earnings were fantastic. Their outlook was fantastic, but the stock is down something in the area of 7% this morning. And so you have to wonder why is that? And the only conclusion I can make is that the stock had gotten so ahead of itself that people are saying, okay, well, everything was good, but it wasn't better than what we thought, so we're going to take profits. So although I think, Vince, I think you're right. I mean, I think the businesses are doing extremely well. You still have to wonder if we aren't a little bit overvalued in the market.
And again, that's another worry that I hear from, and I hear a lot from the value managers now saying, oh, you have to rotate into value stocks because, all the growth stocks are way overvalued, yada, yada, yada. But again, you want to be in companies that are incredibly innovative. You want to be in companies that are growing their revenues at a very good pace. You want to see companies really making a lot of money and not having to just worry about whether the economy does extremely well. So again, I'm eager to see how these earnings reports come out, and as a result of that, I think that we can see a very nice market this year.
Well, yeah, we'll see what happens. But I mean, if you're looking at a GDP of anywhere around 5, which we haven't seen in a long time, my guess is that somewhere along the line, businesses are going to do pretty well.
Oh, absolutely. I mean, that's a big number. That's a real big number.
Right. We'll see if is consistent, or if it is not consistent, but if it can continue on an ongoing basis, or if it's just a one-time blip.
Well, think of it this way. If the economy is growing between 4.5% and 5%, and inflation is pushing down towards the 2.6%, that's pretty darn good. I mean,
is that where inflation is? Do we have any numbers on that?
I thought inflation was around 2.6, 2.7%.
Yeah.
So I mean, when you think about it, that's pretty darn good. I mean, that's Goldilocks territory.
Right. And it could become very well inflationary.
So
Again, it goes back to...
So inflation, consumer prices in November, 2.8% and 2.7% in October.
And the fear and greed index is back in neutral territory.
That's interesting.
It's at 54 right now. So sometimes I'm not sure what is driving, and I know that there's like 7 or 8 different components of the fear and greed index, but you would think that people would be pretty excited about how well the economy is doing right now, yet you've gone from the greed sector to now neutral again.
It's amazing how quickly it moves. It seems like daily.
Maybe people are wondering if they're getting a tax refund or not.
There we go.
A tax refund?
Well, that would help the market a lot.
Yeah, I know. Tax season kicks off in 4 days.
I thought that rich people don't pay taxes.
Do they ever? And this year, it's going to be more than ever important to be planning ahead for taxes.
Because?
So the One Big Beautiful Bill Act, it created multiple provisions that are tied to adjusted gross income phase-outs. And what that means is we want to be implementing strategies that will bring your income down so that you actually can take advantage of these new provisions. So, for instance, the personal exemption deduction for seniors. which is the $6,000. So a lot of people thought that Social Security was not going to be taxable, but that didn't actually make it in the final bill. It's actually a personal exemption deduction for seniors. And it's important that you say it that way because it's in addition to either your standard deduction or itemized deduction. So this is in addition to. So it is $6,000 per spouse if you're married filing jointly.
But that doesn't apply to everybody, does it?
Does not apply to everyone. You have to be over the age 65, and your income has to be within a certain threshold. So if you're single, and if I get these wrong, I apologize in advance because there's lots of different thresholds. If you're single, your income between $75,000 and $175,000, it phases out. So you may not get it if you're single and you make more than $175,000. And then if you're married, starts to phase out at $150,000. And this is interesting, I thought. So if you're married and one spouse is over 65, it's one limit, it's $250,000. And if both spouses are over 65, the upper limit's $300,000.
Oh, interesting. Okay.
Yeah, I just learned that at this webinar I went to. 8 hours of tax law, so fun. Then, of course, the increased SALT or state and local tax limitation everybody talked about. So that's basically when you itemize your deductions, you could get up to $40,000 as a deduction starting on your 2025 tax return through 2029. So this is a temporary provision. But if your income is over $500,000 and phases out completely at $600,000, you may not get this additional deduction. It does. I think they call it phasing down. So it goes from 40,000 down to 10,000. So it doesn't phase out completely. So it just goes down to the 10,000 if you make too much money. So like I said, and there are multiple other provisions, but I'm not going to get into all of those right now. But it makes it more important to be focusing on, okay, what is my adjusted gross income? Because if that is over the certain limits, you don't qualify for these provisions. So making qualified charitable distributions is going to be a big one. Making sure you're harvesting capital losses to offset gains if you have losses. Let's see. Delaying your first RMD in the year that you reach 73 if possible. If you have a business and you have assets, making sure you're not electing out a bonus depreciation because that'll help get your income down. Maximizing retirement contributions if you're of that age. Maximizing HSA or health savings account contributions. And then, making sure that all of the Schedule 1 deductions are claimed. So, for instance, health savings account, traditional IRA contributions, et cetera. So, lots of different things to think of. And so you may remember a few years back, itemized deductions would get a haircut if your income was over a certain amount. They're bringing that back, but they're only bringing that back for people in the 37% tax bracket. So if you're right there, you may consider, what can I do to bring myself back down to the 35% bracket?
Once again, I've said this before. Everyone thinks that, that all of the current policies are favoring the really wealthy, but it seems like, at least in the tax code, the really wealthy are not getting any breaks.
They pay a lot of tax,
right?
And there's a lot of provisions that I didn't even go over because they're affect either lower or middle class taxpayers, like the qualified tips deduction or the qualified overtime deduction, the deduction for interest on car loans, and all of these also have phase outs. So if you make too much, you don't get it.
I wonder how much time is wasted on all of these tax ideas when we could just say 10% across the board on whatever you make. Right. That's it.
Good for me, honestly.
But then what would your elected officials do in Washington, D.C.?
The same thing they do now, nothing.
Well, they just wrote a new tax code.
Yeah, yes, they did.
So it looks like we're all starting to get our tax documents are coming in.
Tax season kicks off Monday.
I know. I was
4
like,
days.
I'm starting to get all these things coming, or I'm getting emails and things in the mail. And for those that have Schwab accounts with us, usually those 1099s and tax documents don't come out until the middle of February. So just know that it's coming. Just we're not there yet, but you should be getting some of your other interest and mortgage and
it's time just to get organized.
Yes.
And don't piecemeal your advisor the documents. Don't send them like, here's my 1099 and here's my...
Why not?
Yeah, that's what you pay for.
It's not efficient. And we have limited time. We have 89 days of tax season.
Well, you couldn't pay me to do what the accountants do in,
no.
what is it, 3 months?
Oh,
I said all these deadlines, it just blows me away with all the deadlines.
the deadline's pretty gritty.
extend.
Yeah,
There you go.
Yeah, and you tell me that tax season really never ends.
never ends.
So, even though the April 15th is a big push, then you've got the June deadline, the October deadline.
September deadline.
Yeah.
Honestly, the October deadline is harder than the April deadline because you can't extend. You have to be done.
That's it.
Well, but by then it's now 9 months after
And
the
then
year.
you're planning for the next year.
Well,
Wow.
Yeah.
well,
So back to the markets.
as I said earlier, there's a lot of uncertainty with what's going on with this new bill and how this tax code is going to affect the economy. And the problem is, since there's a lot of uncertainty, what happens is investors focus on geopolitical events. And that's what we've seen happen over the past really 10 to 14 days. I mean, look at the other day. We were, everybody was clamoring that Trump was going to go in and invade Greenland, and the market got clobbered. Well, all it took was one phrase saying we're not going to do it, we're going to negotiate, and we've had 2 days of a good up market. So my caveat to investors and, clients of ours, if you own high quality, dominant, rapidly growing companies that are very innovative, don't try to make big changes based on geopolitical events. It's just going to hurt your portfolio, and it's not going to help you at all in the long run. So that's kind of like my caveat right now.
I think that's the uncertainty with tariffs, and everyone gets scared. And we felt like, is this the same thing we're going to deal with that we dealt with at the beginning of 2025?
Absolutely.
And
Yeah,
so that's
absolutely.
where you're like, oh, here we go again. But it seems to me that this kind of got nipped in the bud pretty quick.
I
this
think
week.
that you talk about it all the time. You have to be, you have to be confident in what your plan is. You have to be confident in the allocations that you have, and there it is.
I think you should take advantage of these dips.
Yeah. I mean,
it's interesting because especially this particular president is extremely aware of what the markets are saying.
Mm-hmm.
And when he talked about Greenland and what he was whatever he was talking about, the bond market said, not so fast. And all of a sudden you had rates going up very quickly and had a stock market going down very quickly. And then another day goes by and the president kind of doesn't change his mind, but changes his tone. So, I think you have to look at some of these dips in the market as buying opportunities, because honestly, when things get really bad, this particular president goes the other way. And that's been the MO. We can't guarantee it, but that's been his MO.
And I think a lot of people want to buy the dips, but again, we've got, some big earnings reports coming out in the next couple of weeks. So I think if we see some stocks sell off because of that, then I think you can buy some of the dips on these stocks.
Right. The other thing too, we talked about for a long time is there an AI bubble? And I suppose you could make that statement, and then maybe it's half true, but the technology that's come around right now is such a big game changer that I think that a lot of the spending is warranted. And I'm not sure that that's a bubble. A bubble is when there's no earnings and the stock is up to, no man's land or whatever you want to call it. I don't see that right now. I see that the earnings are good and the stock prices are rich, but they're both kind of in tandem. So it doesn't mean that the market can't pull back, and it will, but I don't see a bubble here.
Well, a lot of the big AI companies, and I've seen it, they're trading, somewhere in the 22 to 27 times earnings, forward earnings. And typically the S&P trades at 17.5 times. So it's probably a little bit above the S&P. But when you look at, the technology sector, 22 to 25 times or even 27 times isn't exactly, outsized. It's not.
Right, because they're growing
They're
at
growing
huge
at
rates.
40% or 50%. So, you have to take that into account. And that's why I'm saying anytime you see some of these companies that have great fundamentals, and all of a sudden they pull back on an earnings report, or again, you see something like a tariff announcement or a geopolitical announcement, hey, get your cash ready and just start buying some. You don't have to buy a huge position, but, if you're in a 2-3% position in the portfolio, add another 1%.
I was still thinking about buying some real estate in Greenland.
That's a good idea because, they're going to build some bases and they're going to have a lot of stuff going on there if this all goes to fruition.
It's kind of funny, too, that we're, such a big deal is being made out of Greenland. I think the inhabitable space in Greenland is like what, almost nothing?
Nothing, yeah.
Right, and most of it is just frozen ground.
Well, they do have one golf course. It's 9 holes.
Oh.
And they can only play for, I think, like 3 weeks of the year or something
Of course,
like
you found that out.
They do have a golf
Are you planning on going there?
No. In fact, I bet you that most people can't even point to Greenland on the map.
You know, that might be kind of an interesting trip, going to Greenland, playing 9 holes of golf.
You have to play the course. You have to play the 9 holes twice to get your 18 in.
There you go.
There you go. All right. What else we have this week?
I think that
Nothing.
pretty much
Okay.
covers it.
Well, another week has come and gone, and today is what's the 22nd?
Today's the 22nd.
We'll be back here on the 29th of January to let you know what happened the week before. And until then, happy investing, everybody.
Thank you.
Thank you.
Bye.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.